let's level set here on what a lease modification is. And that is any change to the terms and conditions of a contract that results in a change of scope or the consideration of the lease. The consideration could change based on the timing of it or the amount of it. So a lease modification can be a lot of different things. But one important distinction, there's a fork in the road for whether or not a modification should be treated under modification guidance or as a completely separate contract under 842 and get its own amortization schedules. And those two factors that make it a completely separate contract is if that modification provides you an additional right of use that was not included in the original contract, and if there's an increase in lease payments that is similar to that standalone asset price that you just got access to. So an example I like to use here is that, let's say that you are renting out an office building and you are in the 5th floor of that office building. Let's say that you entered in a lease modification to extend the life of that lease for 5 years, but you're still going to be on the 5th floor for those 5 additional years. That would not be an additional right of use, because if you think about it, you already had the right to use that asset, so you're not getting an additional right to use. However, let's say that your company is growing and you need new space, and you now are also renting the 6th floor of that building. That is, in fact, an additional right of use, and will likely also have an increase in lease payments. So that modification would be treated as a separate contract. As promised, way a long time ago, going into lease modifications, specifically around the payable incentives. So there's a lot of information on the screen, but I really wanted to get the point across that depending on the modification type or what is changing, you do different things. And so when I look at the contingency resolution here, that is for if a incentive, you were unsure if it was probable and in your control until it actually happened, so that contingency was resolved, you would not update your discount rate, versus if you had a change in your lease term, like in my example, you extended it or maybe you decreased it, you would update that discount rate. So depending on the change in that contract, you're going to do slightly different things. And also based on the modification type, there's going to be a different accounting impact. So if it extends or reduces the term, you grant an additional right of use that doesn't have an additional monetary value, or only changes the consideration in the contract, there is going to be no income statement impact. So how the lease liability changes is how the modification or how the right of use asset changes as well. So let's say that the lease liability prior to modification was $100,000, and right after your modification it was $150,000, so it went up. Then you would have a modification for $50,000 where you're going to debit your right of use and your lease liability for that $50,000. So again, as lease liability goes, so does the right of use asset. However, if you have a modification that reduces the scope of the lease through full or partial termination, most of the time you're going to have an income statement gain or loss. When we get to the termination sections, I'll go through some caveats where there is no gain and loss, but most terminations will have that gain or loss. And so for our examples today, we're going to go through operating to operating, but here, if your classification is changing, there are slight impacts to really how that right of use asset changes. For instance, if it goes finance to operating to finance, it's really going to be going how the amortization kind of works in, I guess, finance world today. So it's probably like the easiest transition. I mean, operating is pretty none of these like brain surgery, right? But these guys are slightly different. And I want to hone in, since we're doing operating, how that single lease expense changes. And because the right of use asset is just taking whatever happens to that lease liability, that's why the reduction or the amortization of that right of use asset needs to be dictated by, maybe different set of rules other than an original lease. So also wanted to mention that whenever you have a modification, the initial direct costs that were initially there within the original lease, prepaid rent, lease incentives, any of those variables, those would not be included again because they're already in the lease liability and right of use asset balance. It would only be the incremental. So let's say you had an additional incentive that you received, then you would include that within the modification.